Good
Good
morning,
morning,
everyone.
everyone. My name is Soham,
And my name is Vidit.
and we are here to inform you about the topic known as yield curve. A yield curve is a way to measure a bond investor feeling about the risks and can have a tremendous impact on the returns you receive on your own investment. A yield curve is an important economical indicator because it is central to the monetary policy, a source of information about investor feeling expectation of about interest rates and economical growth and inflation, a determinant of the profitabilities of a bank. A flattening yield curve can indicate economical weakness as it signals that inflation and interest rate are accepted to stay low for a while. Market accept little economical growth and willingness of the bank to lend is weak. A yield curve is involved in the transmission of changes in monetary policy of a broad range in the interest rate of a economy. Rest of part will be continued with a partner known as Vidit.
Hello, everyone. I am Vidit. Yield curve is used to predict the future. It is well known among the stock marketers. It is extremely useful tool for buying stock of different maturities. It can it can differentiate between a singular stock of two different maturities. As you can see in this picture, yield curve is of three types, that is normal, flat and inverted. Normal yield curve means that the economy is stable and the inflation is above. Normal yield Flat yield curve means that the market is stagnant and the market may fall down at any time. Inverted yield curve means that the economy is going down and banks will be extremely hesitant to provide you a loan, as they will have to give you extremely low interest rates on the loan that you take. Over here you can see that this is a singular stock, but the majority of the part to buy is over here. This is the best part as it provides the highest interest rate to you. It is a line that yields interest rates. Thank you.